Think about this for a moment. What if the very thing designed to help your business flow, to bridge those critical cash flow gaps, secretly harbored a dark side? What if the promise of immediate funds came with hidden costs, unforeseen limitations, and a slow erosion of your financial control? Let's start with the most obvious and arguably the most impactful disadvantage: the cost of convenience. Those accelerated payment fees. Payability isn't charity. It's a business. And like any business, it needs to generate revenue. It does so by charging a fee for its service, typically a percentage of your daily or weekly sales that advances to you. While these fees might seem small on a per transaction basis, often ranging from 0.5% to 2%, they accumulate rapidly. Consider a business doing $100,000 in monthly sales. Even a modest 1% fee translates to $1,000 per month or $12,000 per year, simply for accessing your money a few days or weeks earlier. For a business operating on thin margins, which is common in e-commerce, this can be a substantial bite out of your profitability. That $12,000 could have been reinvested in marketing, product development, or even simply added to your retained earnings. Over time, these fees can significantly erode your net profit, turning what looks like a healthy gross revenue into a much less impressive bottom line. It's akin to taking a small interest loan on every single sale, and while the convenience is undeniable, the cumulative cost can be a silent killer for your profit margins. Many businesses, especially new ones, might focus so heavily on top-line revenue that they overlook these seemingly minor percentage deductions, only to find their actual cash flow struggling despite high sales volumes. Beyond the explicit fees, there's a less tangible but equally important disadvantage: the potential for dependency and reduced financial discipline. When you know you can always get your money within a day, there's a natural tendency to become less rigorous about managing your cash flow proactively. Why meticulously plan your inventory purchases or marketing spend when you can simply tap into your future earnings instantly? This can foster a reactive approach to financial management rather than a proactive one. You might find yourself relying on payability not just for true cash flow emergencies, but as a default mode of operation. This creates a cycle where you're constantly paying fees for a service that, with better internal financial planning, you might not need as frequently or even at all. It can mask underlying issues in your business model or operational inefficiencies, preventing you from identifying and addressing them. Another significant drawback lies in the impact on your working capital and potential for over-leveraging. While payability provides immediate liquidity, it does so by essentially accelerating your revenue. This can create a false sense of security regarding your working capital. You might feel flush with cash, leading to overspending or premature expansion, only to realize that you're constantly relying on future sales to cover current expenses. This is a precarious position to be in. If sales slow down, even temporarily, you could find yourself in a bind, unable to meet your obligations without even more expensive short-term financing. It's like constantly borrowing from tomorrow to pay for today, and that's not a sustainable model for long-term business health. Furthermore, if you're consistently advancing your receivables, it means a larger portion of your future earnings are already committed to covering past expenses and payability fees. Let's also consider the potential for data sharing and privacy concerns. When you integrate payability with your marketplace accounts, you're granting them access to a significant amount of your business data. Your sales figures, your product performance, your customer data, though usually anonymized. While reputable companies like Payability have strong data privacy policies, the very act of sharing the sensitive information introduces a layer of risk. In an era where data breaches are increasingly common, entrusting a third party with such critical business intelligence warrants careful consideration. What are their security protocols? How do they use your data beyond facilitating payments? While the immediate benefit might outweigh these concerns for many, it's a factor that shouldn't be entirely dismissed, especially for businesses with highly sensitive or proprietary information. Then there's the issue of limited flexibility and potential for vendor lock-in. Once you start relying heavily on payability, it can be challenging to switch to alternative financing solutions or even to revert to standard payout schedules. The operational rhythm of your business becomes accustomed to rapid payments, and disrupting that can be painful. This creates a form of vendor lock-in, where exiting the service might require a significant recalibration of your financial operations and potentially expose your business to cash flow shortages during the transition period. If Payability were to change its terms, increase its fees, or alter its service in a way that's unfavorable to your business, you might find yourself with limited options due to this established dependency. This is particularly true if you haven't been actively building a relationship with traditional lenders or exploring other forms of financing. The comfort of instant payments can deter you from exploring more cost-effective, long-term funding solutions that might be better suited for your business's sustained growth. And finally, we must address the potential for reduced access to traditional financing. Lenders, when evaluating your business for loans or lines of credit, scrutinize your cash flow meticulously. If a significant portion of your daily or weekly revenue is being immediately siphoned off by a third-party service like Payability, it can present a less favorable picture of your financial health. Banks prefer to see strong, consistent, and unencumbered cash flow coming directly into your primary business accounts. The fact that you're paying a premium for accelerated access to your own funds might be interpreted by some lenders as a sign of underlying cash flow issues or a lack of robust financial planning, potentially making it harder for you to secure more affordable, long-term capital when you truly need it for expansion or strategic investments. They might view it as a high-cost solution to a problem that should ideally be managed internally. While it's not a definitive barrier to traditional funding, it's certainly a factor that can raise questions and potentially impact the terms or approval of a loan. The goal should always be to build a financially robust and independent business. While tools like Payability can offer a temporary boost, the ultimate aim is to cultivate strong cash flow management practices, optimize your operational efficiency, and build sufficient reserves so that you have the flexibility and control to navigate your financial landscape on your own terms. True financial freedom comes not from the ability to constantly access your money faster, but from managing it so effectively that you rarely, if ever, need to pay a premium for that speed. With that said, thanks for watching, and until next time.